Every chip in your phone, your laptop, every AI accelerator powering the models you talk to every day. None of them exist without a company you've probably never heard of. Lam Research makes the tools that actually carve and coat the silicon. And this morning, they reported the best quarter in their history.
Record revenue of $5.84 billion, non-GAAP earnings of $1.47 per share against a $1.38 estimate. And then they guided for another record at $6.6 billion next quarter.
The wafer fabrication equipment market, the total pool of capital spending by chip factories, has been revised up to $140 billion for 2026. Lam's CEO called it a supercycle, and the numbers are starting to back that up.
This is Charged Alpha. I'm Lana Chen.
And I'm Hudson Thomas. Let's dig into Lam Research, ticker LRCX. All right, Lana, let's start with what Lam actually does, because this is not a household name, but it is an absolutely essential business.
Lam Research makes two types of equipment that every advanced chipmaker needs. The first is etch, plasma-based tools that carve microscopic patterns into silicon wafers with extreme precision. The second is deposition, tools that layer ultra-thin films of material atom by atom onto those wafers.
And those two processes happen hundreds of times per chip. You're literally building three-dimensional structures that are smaller than a virus, and Lam's machines are doing the carving and coating.
The company serves every major fab in the world. Samsung, SK Hynix, Micron, TSMC, Intel, they all run Lam equipment. And when Lam qualifies a tool on a customer's production line, the switching cost is enormous. You're talking years of requalification work and billions of dollars of yield risk.
So once you're basically in forever. That's the moat.
It gets better than that. Lam has an installed base of over 100,000 individual chambers operating at customer fabs around the world. Each one needs parts, service, recipe updates, and upgrades. That business, they call it the Customer Support Business Group, or CSBG, just hit a record $2 billion in a single quarter.
So even if chip makers pause their capital spending for a year, Lam still collects $2 billion a quarter, just keeping the existing machines running.
Exactly. It's like selling printers and then making all the ink. The installed base is the annuity, and it keeps growing with every system sold.
Lam was incorporated in Fremont, California, and today employs roughly 18,000 people. It's not glamorous, no consumer products, no brand recognition, but the company controls one of the most defensible positions in the entire technology supply chain. Let's talk about who's running this company. Tim Archer has been president and CEO since December 2018, so coming up on 7 years in the seat.
Archer's path to CEO is unusual. He joined Lam through the 2012 acquisition of Novellus Systems, where he had been running product development. Before Novellus, he was actually a process engineer, which means he understands the physics of etch and deposition at a level that most CEOs of this scale simply don't.
He's got a mechanical engineering master's from Stanford and a bachelor's from UC San Diego in applied mechanics. This is a technically literate CEO making technical product decisions, not just running a spreadsheet.
Analysts credit him with two things. First, expanding Lam beyond pure etch into a broader deposition and services company. Second, the Equipment Intelligence Initiative, embedding AI directly into the tools themselves to optimize yield and predict failures before they happen. Customers pay a premium for it.
And the capital allocation track record is strong. Lam has returned over $20 billion to shareholders over the past decade through buybacks and dividends, while continuing to fund R&D. That's not a company that's choosing between growth and returns. It's doing both.
The credibility question going forward is whether he can navigate the China exposure without a policy surprise blowing up the thesis. At 43% of systems revenue, that's the number the street watches more than any other.
All right, let's get into the numbers. Lana, you've got the latest financials. Where do we start?
Let's start with valuation, because Lam is not cheap and the market knows it. The stock trades at about 50 times trailing earnings and 15.3 times trailing revenue. Forward price to earnings comes down to around 39 times on next fiscal year estimates. EV to EBITDA sits at 43.8 times.
So this is priced like a high-growth tech company, not a cyclical industrial.
That's the market's bet. that the equipment spending cycle has enough structural tailwinds to justify a premium multiple. The beta is 1.45, so it moves more than the market in both directions. 52-week range is wide, high of $273.50, low of $66.34.
Let's talk about the actual business results. Q3 fiscal 2026, which covers the first 3 months of calendar 2026, revenue came in at a record $5.84 billion. That's up 23.7% from the same quarter a year ago.
Gross margin was 49.8%, operating margin 33.76%, and net margin 30.22%. For a company processing nearly $6 billion in revenue in a single quarter, those are exceptional margins. The etch and deposition tools have significant software and intellectual property content baked into the pricing.
And the income waterfall for the quarter. Revenue $5.84 billion, cost of goods $2.93 billion, gross profit $2.91 billion, operating expenses $936 million, and operating income $1.97 billion, net income $1.77 billion.
Now, the balance sheet, cash on hand is $5.8 billion. Total debt is $4.9 billion. So Lam is actually in a net cash position. They have more cash than debt, which is unusual for a company this size that is also returning billions to shareholders.
Net cash is roughly $900 million. Current ratio is 2.26. Interest coverage is over 18 times. This is a company that has no financial stress whatsoever.
Return on equity is 65.56%. That's elite-tier capital efficiency. Every dollar of equity Lam keeps on its balance sheet is generating 65 cents in net income per year.
Free cash flow for the trailing 12 months is $5.2 billion. Operating cash flow in the most recent quarter alone was $2.1 billion.
Lam pays a dividend. The annual payout is $2.80 per share, yielding about 1.6% at the current price. Dividend growth has averaged 14.2% per year over 5 years, and the company bought back $4.8 billion in stock over the past 12 months.
So they're doing both meaningful growth buybacks and a growing dividend, while sitting on a net cash balance sheet.
Overall, Lam Research's financial health is strong, exceptional margins, net cash position, elite return on equity, and $5.2 billion in annual free cash flow, supporting both capital return and R&D investment simultaneously.
What is Wall Street saying about Lam right now?
The street is broadly positive, 27 buy ratings, 9 holds, and 0 sells out of 36 analysts covering the stock. Average price target is $275, which gives you about 3.6% upside from where the stock is trading today. Target range runs from $200 on the low end to $325 on the high end.
So not a lot of room between the current price and the average target, but the high end of the range suggests there's a meaningful bull camp that sees a lot more from here.
JP Morgan raised their target to $300 after the earnings print, arguing the WFE expansion to $140 billion is structural, driven by AI memory and transistor architecture changes, not a cyclical bump. Bank of America reiterated buy at $310, specifically citing Lam as the best-positioned vendor for the gate-all-around transistor ramp.
And on the other side,
Morgan Stanley is at equal weight with a $235 target. Their thesis is straightforward. China is 43% of systems revenue, and accelerating export control risk is a ceiling on how high the multiple can go. That's not a wrong concern, it's a real risk, but it's kept them on the sidelines through most of Lam's recent run.
And the earnings themselves, this morning's print?
Non-GAAP EPS of 1.47 against a 1.38 estimate, a 6.5% beat. Revenue of $5.84 billion against a $5.72 billion estimate. Both metrics are records. Q4 guidance came in above expectations at $6.6 billion, and the full-year WFE outlook was raised to $140 billion. Clean beat, strong guide, no asterisks.
All right, let's make the case for Lam, and honestly, there are some very compelling structural arguments here. The first and most important is the gate-all-around transistor transition. The entire semiconductor industry is moving from FinFET transistors, which are essentially fins sticking up from the wafer surface, to gate-all-around architectures, where the gate wraps around the channel on all 4 sides. Intel, TSMC, Samsung, all 3 are ramping this simultaneously. And gate-all-around requires 25 to 30% more etch and deposition steps per wafer than the technology it replaces. That is structural market share for Lam, regardless of unit volume. Every advanced chip made with the new architecture needs more of Lam's tools per chip than the old one did. The second driver is 3D NAND. Flash memory has been adding layers since the technology was invented. You stack storage cells vertically to get more density. The industry is moving from 128-layer stacks to 200, and the roadmap goes to 300 and beyond. Lam's high aspect ratio etch tools are the only ones that can carve channels through stacks that deep with the precision required. Every additional layer is directly incremental to Lam's addressable market. Third is the HBM build-out. High bandwidth memory is what sits on top of every AI accelerator. The NVIDIA H100, the GB200, all of it. HBM uses a bonded stack of DRAM dies, and each DRAM die requires significantly more deposition steps than standard memory. Every AI chip shipped is a Lam revenue event. And fourth is the customer support business group. They hit $2 billion in a single quarter for the first time ever. That number grows as the installed base grows, and the installed base grows every time a new system is sold. It's a compounding annuity.
The bear case, in my view, starts and ends in Beijing. China was 43% of Lam's systems revenue in the quarter we just discussed. That is not a rounding error. That is nearly half the company's equipment sales going to Chinese customers. The U.S. government has progressively tightened restrictions on what semiconductor equipment can be sold into China, and there is no reason to believe that trend reverses. A single executive order expanding the entity list or lowering the capability thresholds could remove billions of dollars of revenue overnight. The second concern is the NAND recovery. NAND flash was 11% of systems revenue this quarter, down from 18% just 3 months ago. Memory customers cut capital spending sharply in 2022 and 2023, and the recovery has been uneven. If NAND spending stalls again, which happens when memory prices fall, the bull thesis on Lam's growth trajectory takes a direct hit. Third is valuation. At 50 times trailing earnings and 15 times sales, Lam is priced for perfection. The stock has been a massive winner, but at these levels, the margin for error on guidance is essentially zero. One quarter where guidance disappoints even modestly could reprice the multiple in a way that's painful, even if the underlying business is executing fine. And fourth is customer concentration. Samsung, SK Hynix, Micron, and TSMC account for the vast majority of Lam's revenue. If any one of those four decides to pause spending for a quarter or two, it shows up immediately in Lam's results.
Let's put Lam in context against the other major equipment names.
3 natural comparisons. Applied Materials is the largest semiconductor equipment company by revenue. Broader process coverage, similar customers. It trades at 11.2 times sales and 40.7 times earnings. That's a significant discount to Lam on PS, which reflects the market's view that Lam's margin profile and growth rate in the current etch-heavy cycle deserves a premium. KLA Corporation dominates process control and inspection. They make the tools that check whether the chips being built are within specification. It's a higher margin, less cyclical niche. KLA trades at 12.5 times sales and 43 times earnings. The discount to LRCX's 15.3 times sales suggests the market is assigning Lam's etch leadership in the current NAND and logic ramp a premium that even a business as strong as KLA doesn't fully match.
And ASML is a completely different animal.
ASML is the monopoly supplier of extreme ultraviolet lithography equipment. No alternatives exist. No one else can make EUV machines. But it trades at 8.5 times sales precisely because its capacity is already fully committed. EUV can't ramp faster than ASML can build machines. Lam's addressable market, by contrast, expands with every new layer added to a 3D NAND stack or every new gate all-around chip placed into production. That optionality is what justifies the PS premium.
What does the options market tell us about how traders are positioned in Lam right now?
Implied volatility is sitting around the 42nd percentile historically for LRCX. That's moderate, elevated compared to mega-cap tech names, but not signaling unusual stress or euphoria. Post-earnings, open interest is weighted toward calls at the $280 to $310 strike range through June expiry. The market is pricing in additional upside into the Q4 FY 2026 print.
So the options market is broadly bullish, but not wildly extended.
There is meaningful hedging activity in the $220 to $240 put range, which is consistent with real institutional positions protecting against a China export control shock. It's not paranoia, it's a genuine risk that the options market is pricing appropriately. This is not a high-drama name. It's a large-cap equipment company, so the overall structure is sensible, not speculative.
Any notable insider buying or selling at Lam?
4 insider sales in the recent window, including approximately 6,000 shares sold by CEO Tim Archer at an average price of $263.40 through a pre-arranged Rule 10b5-1 plan. No open market discretionary buying.
The 10b5-1 plan sales are the norm at large-cap companies where executives hold concentrated stock positions. These are scheduled in advance and not a real-time signal of management's conviction about the stock. Nothing alarming in the insider picture. What are the key risks and catalysts an investor needs to track?
The big catalyst to watch is gate-all-around ramp timing. Every quarter that TSMC, Samsung, and Intel add capacity for their next-generation transistor architectures is a quarter where Lam's content per wafer grows. If those ramps accelerate ahead of plan, Lam's revenue growth beats estimates structurally.
And on the risk side,
the single metric I'd watch most closely is the China revenue percentage. If it starts moving down before the gate-all-around and HBM demand fills the gap, that's a warning sign. If China stays elevated while other geographies also grow, meaning China isn't crowding out global business but adding to it, that's the ideal scenario.
The other thing to track is CSBG. At $2 billion per quarter, it's already a record. If it grows toward $2.5 billion, the installed base is compounding at high margins, regardless of what new systems spending does. That's the durability story. If it plateaus, the bull case becomes more dependent on new capital equipment cycles staying hot.
And forward estimates for WFE spending, management just raised to $140 billion. If industry data points suggest that number is conservative, the bull case strengthens materially.
All right, let's wrap this up. Lana, bottom line on Lam Research?
Lam Research delivered a clean beat on the quarter. Record revenue, record earnings, strong guide. The structural thesis is intact. Gate-all-around and 3D NAND layer escalation both require more of Lam's tools per chip than anything that came before. The customer support business is compounding quietly in the background. The balance sheet has more cash than debt. This is a well-run, high-quality industrial with elite margins. But you are paying 50 times earnings for a semiconductor equipment company. The last time the WFE market ran this hot, it eventually turned. And 43% of systems revenue coming from one geopolitical risk, China, is a real exposure that the multiple only partially reflects. The bull case is compelling. The risks are also real.
The one number to watch going forward is that CSBG figure, currently $2 billion per quarter. If it keeps growing, Lam is building a business that works in good equipment cycles and bad ones. That changes the quality of the earnings and potentially justifies a structurally higher multiple over time.
Before we go, there was a line on the earnings call this morning that really captured the moment for Lam.
Hit me.
Tim Archer said our customers have moved WFE spending expectations higher across all device segments. We now believe 2026 WFE will be in the $140 billion range, with a bias to the upside.
A bias to the upside. On a market that was already at a record, that is a CEO who is seeing demand that is real, not predicted. That's going to do it for this episode of Charged Alpha, the S&P 500 stock encyclopedia. If you found this useful, share it with someone who's trying to make sense of the semiconductor equipment space. Because honestly, these companies don't get enough coverage for how important they are. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.